Hey folks, welcome you all to a new video. This is CA Ganesh Bharadwaj. So in this video, I am going to share with you all the question paper review and the detailed MCQ solutions for your paper 6A financial management of your Jan 2025 attempt. Now, I am once again very happy that 45 marks came exactly from those portions that I had given you as the one day before exam strategy, right? In fact, if you remember, you can even go and watch that video. I had told you the top 5 areas, the top 5 topics, and I told you that these 5 topics put together will come somewhere approximately to 36 marks. Exactly these 5 topics put together came for 36 marks, right? The internal composition changed, but if you add up, it exactly came to 36 marks. And over and above that, for safety side, I asked you dividend decisions, maybe don't do the entire chapter, do Walter model and approach. I told you exactly from Walter model, one 5 mark question had come. And working capital management, it's a big chapter. I told you instead of omitting it fully, you can do 2 segments. One is receivables management, the other one is operating cycle. Operating cycle came for 4 marks, but receivable management didn't come. I was expecting that, but it didn't come. Instead, from cash and treasury management, they asked one question, right? So overall, the exam paper got printed for 62 marks, out of which you had to write for 50 marks, and out of which 45 marks exactly came from our prediction, that is from our all-time high scoring topics, right? This is about it. So that's the reason why I told you these 4 chapters you do it fully, and the remaining 3 chapters I had handpicked some areas and specifically told you focus on this, and then if you still have time, maybe you can go around and do it. Had you followed that strategy in a minimum amount of time, you would have covered about 45 marks out of the 50 mark component in this FM paper, right? So overall, how was the paper? The exam paper was easy. This was the feedback that I got from the students, and of course I personally reviewed the entire question paper as well. But here and there, 1 or 2 questions were a bit lengthy as well, right? For example, there was one question from capital structure theories, right, which was a case study based MCQ, 10 mark. That was a little lengthy, right? It would have taken you 20-25 minutes time just to solve that particular question. Yes, there were some areas which were a bit lengthy, but overall, if you see, the questions were straightforward, and I noticed a few questions that were directly picked and lifted from our classroom discussion questions. So had you properly done our classroom discussion questions itself, that would have contributed to a lot of marks in this component, right? So this is what this was my observation, and this is the overall review on this FM component. I'm just talking about the 50 mark component of financial management, and here I have given you the detailed breakup, right? Question wise breakup. The case study one question, it carried 4 marks. It came from the chapter ratio analysis. Then there was one 1 mark question from working capital, direct. It was a direct question. And then this case study 2 question, which carried 10 marks, it came from the chapter capital structure. This was the question that I told you that a bit lengthy, right? So one ABC 555 each from working capital management. Under the cash management they are tested. This is the question where I predicted receivables management will come, but instead they tested cash management. But guys, this question was also manageable, right? Because this was simple. This was a straightforward question. Once again, they had taken this from our study material, institute study material only. And even if you didn't know anything about working capital management, still you will be able to manage this question, because it was more similar to your preparing a cash budget, that is similar to your receipts and payment account only, right? But in a statement format. Then leverages, one 5 mark came in, and then dividend decisions, exactly that Walter model sum came here. And cost of capital, 7 mark, 2A question, 2B question, working capital management, 3 marks came from your operating cycle. And then question number 3A, investment decision with 6 mark, and 3B, 4 mark question from ratio analysis, which was again a missing figure. That is basically your balance sheet preparation. And then the last question, a 12-mark component, was theory, right? This is the overall structure of this particular question paper. So now let me quickly get into the MCQ solutions, right? So I will be solving the MCQs for you guys in this particular video, right? I'll be sharing the solutions, and of course, apart from that, overall, we'll just skim through the questions in the descriptive component as well, right? So now, second, so this is part 1, right? So part 1 is your MCQ. 1 second, guys. Yes, part 1 is your MCQ. In the case scenario 1, The first question, VP Limited provides the following information. The current ratio was 1.5:1. Then your sales was 150 lakhs, out of which 80% was credit sales. Inventory turnover ratio was 6 times. Average collection period was 2 months. The gross profit ratio was 20%, and the quick ratio was 1:1. Right? So from the information, they've asked you to calculate the current asset, current liability, inventory, the stock figure, and debtors figure. These are the 4 things that they've asked you to calculate. Now, guys, I've just put it on an Excel format, so it will be easier for us to quickly, discuss here. Of course, you don't have the luxury of using all this Excel file in your exam, but nevertheless, this is just a discussion that I'm making. Now, yes, based on the figures given here. So first, let's use this inventory turnover ratio. They're given inventory turnover ratio is 6 times, right? So the formula for that is COGS divided by your stock, which was equal to 6, right? So the COGS figure you can easily find out because they have given the gross profit ratio was 20%, right? Which means the COGS is going to be 80% of sales. So 150 into 80%, 120 lakhs is going to be your COGS figure, right? So now you just need to substitute it here. So here it's going to be COGS was 120 lakhs, right? Divided by stock is equal to 6. So obviously it goes, stock goes to the other side. Stock is equal to 120 lakhs divided by 6. That gives you 20 lakh rupees figure. Here, this is just a cross multiplication. Then current ratio, they have mentioned that it's equal to 1.5:1. So in other words, current asset upon current liability is 1.5. So you can rewrite it as current asset is equal to 1.5 times current liabilities. Similarly, quick ratio was given as 1:1, right? So quick ratio is what? Current asset minus stock, right? That's the quick assets divided by current liabilities. That is equal to 1:1. That's what they have given, 1 by 1. So, or in other words, you can cross multiply and you can say that current asset minus stock is equal to current liabilities because it is multiplied with 1, it equals to the same thing. Fine. So now what you can do here is this is the base on which you are going to work. So current asset can be rewritten as 1.5 current liabilities. So instead of current asset, we are rewriting it as 1.5 times current liabilities, and stock figure we just calculated is as 20 lakhs, right? So if you now insert all these figures here, the entire equation will be having only one variable, which is current liabilities. So if you just LHS equal to RHS, simple calculation. So if you do it, you get current liabilities equal to 40 lakh rupees. Current assets is 1.5 times 40 lakhs. So current asset figure is going to be 60 lakh rupees. So with this, we got current liabilities, current asset, and we got the stock figure. And now you need to calculate the debtors figure. They have given the question that average collection period is going to be equal to 2 months. Average collection period, what is the formula? Debtors divided by credit sales into 12, right? That is equal to 2. Just fill in the figures. Debtors figure, that's something that we need to find out. Credit sales is 150 lakhs into 80%. They have given in the question that 80% of the total sales is only credit sales. So 150 lakhs into 80%, that's a credit sale figure, right? Into 12 is equal to 2. You cross multiply, you get the debtors figure as 20 lakhs. Are you clear with this? So now with this, so your current asset, current liabilities. So what's your current asset, current liabilities? Current assets is 60 lakhs. Current liabilities is 40 lakhs. So it's going to be 60 and 40, option number C. And then finally your inventory and receivables, they've asked the question. So inventory figure, we got it here already, 20 lakhs. And the receivables figure is going to be 20 lakhs again. So it's 20 lakhs and 20 lakhs, option number A. As simple as that, guys. 2 plus 2, 4 marks in your pocket. Fine. That's about this particular question. The next question. This is a very vanilla, straightforward question. JKL Company Limited has current assets of 1 crore and current liabilities of 50 lakh. Right? The finance manager of the company desires to make a provision for contingencies, the rate of 20% of the working capital. Accordingly, what would be the amount of working capital requirement? Very simple. Current asset is 1 crore, that is 100 lakhs. Current liability is going to be how much? 50 lakhs. So the gross working capital, or not the gross working capital, technically the working capital requirement is going to be 50 lakh. But this guy, as a safety measure, he wants to provide for 20% contingencies. So the working capital requirement is going to be 50 lakhs into 1.20 or 120%. So how much is that going to be? It's going to be 60 lakhs. As simple as that. 1 mark question, direct calculation, right? The actual working capital, add contingencies, you will get your working capital requirement, 60 lakh rupees. Are you clear with this? 1 more mark. So now 5 marks is over here. Now comes the case scenario number 2. This is where, this was a little bit lengthier in order to solve. Right now that I've solved everything and I've kept it here, it's fine. But in the exam, all of this question came in. Yes, it would have taken some time, but trust me, guys, it was not difficult. It was not difficult. It was just a little more lengthier as compared to the other questions. Right now, I'm just reading out the question for you. Coral Limited is an agri-business company that operates in 2 segments, animal feed and crop protection. The company's R&D department has been instrumental in its growth and success. All this data is irrelevant. Now, the existing capital structure of Coral Limited is as follows. Equity shares, 10 lakh shares, the rate of 10 each, 1 crore rupees. 15% debentures, 30,000 debentures, rate of 100 each, 30 lakh rupees. Coral Limited desires to expand its horizon in breeding high-yielding and disease-resistant seeds for increasing agricultural productivity. The company requires additional funds amount to 100 lakh rupees. So currently they have a total of how much? 130 lakh, right? 1 crore plus 30 lakh. Further, they need 100 lakh rupees of funding, right? Overall, post raising this additional funding, what will be the entire capital structure and entire capital employed is going to be 230 lakhs, right? Now, they need this additional 100 lakhs to finance its business expansion plan. The expected earnings before interest and taxes after this additional investment will be how much? 76 lakhs. So they are saying post introducing this 100 lakh rupees, the company will be having an EBIT of 76 lakhs. So existing EBIT plus from this particular expansion, how much ever gets, that is post the expansion, total EBIT of the company is going to be 76 lakhs. This is what they've given. The applicable corporate income tax rate is 30%. Perfect. The company has two alternatives for raising this additional fund, right? So basically the 100 lakh rupees, they are giving two options, plan number 1 and plan number 2, right? So for the respective plan they have given, in plan number 1, equity shares, right, at the rate of 10 each, issued at a premium of 15 rupees per share, which means the issue price will be how much? 25 rupees per share, correct? So 10 plus 15, be very careful. 15 rupees is not the issue price. 15 rupees is the premium amount, right? So the issue price will be how much? 10 plus 15 is going to be 25. And then, so equity, debenture and preference, three sources of finance are there. Right, plan 1 says 30% from equity and 70% from debenture portion. Plan 2 says 10% from equity, 50% from debentures and 40% from preference. And debentures and preference are at par only. And remember one more thing, these debentures are issued at the rate of 13%. Existing debentures are at the rate of 15%. So this is a different class of debentures altogether being issued. Right, now you are required to answer the following. Number 1, what would be the market price per share of the company if the PE ratio of plan 1 and plan 2 is so and so? It's given in the question. Then number 2, what would be the financial break-even point of plan 1 and 2? Number 3, what would be the indifference point between plan 1 and 2? And then what would be the EPS of plan 1 and plan 2? And what would be the EPS in plan 1 and plan 2 at the indifference point as calculated by you above, right? So basically only if you get this question right, you will be able to attempt this question and you will even get this question right. Are you clear with this? These two are interlinked. And finally, what would be the EPS of the company in plan 1 and plan 2, right? Basically what you need to do, first you need to arrive at the capital structure post introduction of this additional funds, right? Number 2, since they have asked for EPS, you also need to calculate the total number of equity shares under both the plans. These two are the things that you need to do. And finally, what you need to do, prepare this income statement. So EBIT minus interest gives you EBT minus tax gives you EAT minus preference dividend gives you EFP, and divided by the number of shares gives you EPS. This is something that you need to do. Of course, multiply it with PE ratio, PE, price earnings ratio, you get your MPS as well. This is the format that you need to follow. As simple as that. Are you clear with this? Fine. Now, the first thing that you can do is you can arrive at this EPS. The moment you get this, the last question, generally this is what they do. Ideally, the first answer that you will arrive at is the last question only, right? The moment you get this figure, multiply it with the respective PE ratio, right? You will get what? You will get this figure, MPS, correct? So basically, if you do the last question, right, out of this, in this question, 5 questions are there, no? In this case study, first you do the last question, right? Obviously, only then you can do the first question. Are you clear with this? So that's about it. Anyways, nevertheless, now let me just quickly walk you through this. So I have solved this entire question here. 1 second. I hope you can see this. Yes. Right. So first of all, I have the question with you. Currently, they've given the question that, okay. So currently, how much does the company have? 1 second, guys. I'm just reducing the thickness here. Okay. Right. So currently, how many shares does the company have? Currently, so under plan 1 and 2, currently the equity value is going to be 1 crore and 1 crore respectively, 10 lakh shares. It's given in the question. Now, new equity shares, how much is it going to be? Now look at this. They have given in the question. They have given in the question that, right, in plan number 1, right, 30% of the additional source is going to come from equity shares. So 30% of 1 crore, that is going to be 30 lakh rupees, is going to be from equity shares. Whereas in plan 2, what have they mentioned? In plan 2, 10% of the total additional capital employed, additional funds of 1 crore is going to come from your equity shares. So 10% of 1 crore, this is going to be 10 lakhs. This figure is also sorted. Then 15% debentures existing, it's 30 lakhs, 30 lakhs. It will not change, right? Then how about your new 13% debentures? It's given in the question under plan 1. 70% of the additional funding comes from your 13% debentures. So 70% on 1 crore, 70 lakh rupees. Whereas in plan 2, what happens here? In plan 2, it's going to be 50% of your 1 crore rupees. That's going to be 50 lakh rupees. And then preference shares, 7.15% preference shares. Under plan 1, nothing. Under plan 2, they have given in the question that 40% of the entire new funding comes from what? Preference share capital. That's going to be 40 lakh rupees, right? If you add up the two, obviously the total capital employed under both the plans will have to be the same, 2.3 crores only. Obviously what changes is this internal composition, as simple as that. Clear with this, guys? Fine. This is how we have arrived at these figures. And now you also need to calculate the number of equity shares. So why do we need this? In order to calculate the EPS. Existing, it's going to be 10 lakh, not a problem. New, under plan 1, total amount, how much am I raising? Here it's given 30 lakhs, correct? 30 lakh rupees worth of equity shares I'm raising. Each share I'm going to have an issue price of 25. So 30 lakh divided by 30 lakhs divided by 25 rupees. So now the total number of new equity shares is going to be how much? 1,20,000. And similarly, under plan 2, I'm going to raise a total amount of 10 lakh rupees. Each share I'm going to issue at an issue price of 25 rupees. So 10 lakh divided by 25, it's going to be 40,000. I'm raising 10 lakh rupees from the equity channel, and every share gives me 25 rupees. Number of equity shares is going to be 40,000. So under plan 1, right, the total number of equity shares is going to be 11.2 lakhs. Under plan 2, it's going to be 10.4 lakhs. Clear with this? So now we have calculated all this. So now it's just a matter of plugging in the figures. So now the format of your income statement, you need to put EBIT minus interest, EBT minus tax, EAT minus your preference dividend, EFP, divided by the number of equity shares gives you EPS, multiplied by PE ratio gives you MPS. As simple as that. So now EBIT, it's given in the question that 76 lakhs is the current operating profit, or EBIT. They have given it in the question itself. So this goes without saying, this figure is given 76 minus interest. Under plan 1, how will you compute interest? Very simple, very simple. On this figure, if you see, right, on 30 lakhs it is going to be 15%, on 70 lakhs it is going to be 13%. Two different classes of debentures are there. That is exactly what I have done it here, and you will get a total interest of 13.6 lakhs. Under plan 2, what will happen? On this 30 lakhs, you will be applying 15%. On this 50 lakhs, you will be applying 13%. If you add the two, you get how much? A total of 11 lakh rupees. Are you clear with this? So subtract the two, you get the EBT figure minus tax rate, 30% applied on EBT, right? You get your EAT figure minus preference dividend. Plan 1, no preference, 0. Plan 2, how much is it? 7.15% on this 40 lakh component rupees. So how much you get? You get a preference of 2,86,000. You subtract that also, you get your earnings available to equity shareholders. These are all calculation driven. This is what I said. Since I put it in an Excel file and presenting, I'm just doing it quickly. But if you have to take out your pen and put it on a paper, it might take some time. I do understand. That's the reason why I said this question was a little lengthier, right, as compared to the others, right? Number of equity shares given in the question as 11 lakh. I mean, it's not given. We just computed above 11.2 lakhs and 10.4 lakhs. You divide the two respectively. EPS under plan 1 is 3.9. EPS under plan 2 is 4.1, right? And then you multiply it with the PE ratio, 12 and 15. How do we know the PE ratio? It's given in the question as 12 and 15 respectively, right? You arrive at the MPS. EPS into your PE ratio gives you MPS. As simple as that, right? Yes, that's about it, right? So now with this, we have arrived at the figure. So first, EPS is going to be 3.9 and 4.1. Look at this. Last one, 3.9 and 4.1, option number C. And immediately what you can do, you can also calculate the MPS. How much is the MPS, guys? It's going to be 46.8 and 61.5. 46.8, 61.5, option number A. And this part is also over. The next part of the question, they've asked you to calculate the financial break-even point, right? Financial break-even point. What do you mean by a financial break-even point? It is that point of EBIT where my EPS is equal to 0. Or in other words, how much EBIT I should earn so that it exactly recovers my fixed financial cost. So what is the formula for that? All these logics we have seen. Interest plus preference dividend into preference dividend divided by 1 minus t. I'm sorry, here I have mentioned it. Okay, in the formula application I've done it right. One second. it's divided by 1 minus t, right? Interest plus preference dividend, that component alone divided by 1 minus t. Very simple. The reason is interest is already pre-tax, right? Preference dividend is post-tax. I'm converting it into pre-tax. As simple as that. The entire logic we have seen it, right? So based on this application, we have the interest figure, we have the preference dividend figure, and the tax rate is given in the question as 30%. Direct formula substitution here, guys. So in case of alternative number 1, the total interest is how much? 13.6 lakhs, right? We've just computed 13.6 lakhs plus 0 divided by 1 minus 0.3. 0 is no preference dividend. So it's going to be 13.6 lakhs, right? And then in case of alternative number 2, it's going to be 11 lakhs. 11 lakhs is going to be my interest component plus, look at this, plus 2,86,000 divided by 1 minus 0.3. 2,86,000 is going to be my preference dividend. As simple as that. If you do this, so your financial break-even point is going to be 13.6 lakhs and 15,08,571.43. So if you're, so you can even check this, cross verify it, right? Now you can do it later on as well, right? At this level of EBIT, exactly in alternative 1, if your EBIT is 13.6, exactly your EPS will be 0. Similarly, for alternative number 2, if it is 15,08,571.43, your EPS will be 0 under alternative number 2, right? And yes, it's going to be option number D. 13.6 lakhs and 15,08,571. This is exactly what you've got, right? So that's about this particular part of the question as well. Then coming on to the indifference point, literally see in this question, they have, if you see in our regular lectures, I would have bifurcated this entire chapter into 4 parts. First part is your indifference point. Then part 2, part 1 was your indifference point. Part 2 was your break-even point. Part 3 was basically your EBIT, EPS analysis, MPS analysis. And part 4, I would have taught you capital structure theories. In this question, the first 3 parts of this entire chapter, they have clubbed it and they have asked questions across the first 3 parts. Look how beautifully they have framed this question. This is how questions are getting framed, and without conceptual understanding, you cannot even touch these kind of questions, right? That's the power of conceptual learning. Now, going on to the next one, what would be the indifference point? Now, what do you mean by indifference point? One second. So yeah, what do you mean by indifference point? Indifference point is the point of EBIT where the EPS and EPS under the 2 alternatives are equal, or in other words, the EBIT point at which the EPS under both the alternatives are equal is called as the indifference point. So what you need to do, calculate, we need to find that EBIT which makes the EPS under both the alternatives equal, right? So keep the EBIT alone as EBIT, the variable, because we need to find that, right? Minus your interest, right? And into 1 minus t, right? That gives you what? That gives you your earnings after tax, right? Minus preference dividend, it is not here. That gives you EFP divided by the number of shares, 11,20,000, right? So under the first plan, it's going to be EBIT minus 13.6 lakhs interest, right? Into 1 minus t, that is 70%, minus preference dividend 0. I'm not putting it here, divided by 11,20,000, right? This is the calculation of EPS under first plan. This should be equal to, what is the EPS calculation under the second plan? It's EFP divided by what? Number of equity shares. How do you arrive at the EFP? EBIT minus 11 lakh rupees. Here the interest component is 7 lakh, right? Into 70%. This gives you what? EAT, right? Minus preference dividend. This gives you EFP divided by your 10,40,000, right? Now you equate these two, right? I have done all this cancelling and all these things. Long story short, if you do all the calculation here, finally you arrive at an indifference point of 34,40,000, or in other words, if my EBIT is exactly 34,40,000, EPS under plan 1 and EPS under plan 2 will be the same. This is called as indifference point. So the answer is 34.4 lakhs. Here I've shared the approach, and this one I took some time to solve it, and then I have arrived at this final answer. So the answer here is going to be option number B, 34.4 lakhs. Now, if 34.4 lakhs is going to be your EBIT, what will be the EPS under plan 1 and plan 2 is the next question they have asked. What would be the EPS under both the plans at the indifference point calculated above? Suppose you got this wrong, obviously this answer is also wrong. This is something that you need to be very, very cautious about. It is called as a chain error. One question gone, the other question is also gone. Be very careful about this. So now what happens here, guys? Now this is where you need to be very smart. Let us say, right, already it took some time. I'm not willing to spend more time here. The first thing I will do is, what are the options they have given, right? They have mentioned calculate the EPS under both the plans, right, at the indifference point. Obviously, at the indifference point, EPS under both the alternatives will be the same, correct? So first I will remove those options where the EPS under two alternatives are different. So here if you see 1.6 and 1.75, I will remove this option. Then 1.8 and 1.9, I will remove this option. The final answer could only be option A or option C. You have made it 50-50, right? Suppose, let us say you are just 1 minute away, right, from the exam time to get over, and you are stumbling in this question. I would say instead of 4 options, now you have only 2 options. At least one will be right. You can get it and you can come out of the exam hall. Clear with this? This is how you need to strategize, provided you know the concept. At the indifference point, obviously it has to be the same, right? So now what do you need to do? Once again, you need to rework here. 1 second. So this is all we need to do. So now EBIT 34.4 lakhs, right? You can do for any one plan, that will do, guys, because it's going to be the same only, right? Minus interest. So at 34.4 lakhs, once again, I have prepared the entire statement. EBIT minus interest, EBT minus tax, EAT minus preference dividend, EFP divided by number of shares. We got 1.30. Exactly for plan 2 also, it is coming out to 1.30. So the final answer is going to be option number A, 1.30. As simple as that, guys. Any complexity, any difficulty here? Absolutely not. It was a plain question. Plain question. No catches, nothing. The only difficulty in this question could have been the length of the question, right? It could have been lengthy, but for that, this question is pretty much straightforward, and I'm sure you would have found it easy, right? Because this is all conceptual. If you learn the subject conceptually, this entire paper was actually very, very simple, right? So that's about this particular segment of MCQs, the 15 mark component in MCQs, right? And let me just quickly walk you through the descriptive part as well, right? Question number 1A, 1 second. Yes, so question number 1A. So this question came from working capital management, right? Here they had asked you to prepare a cash budget. Guys, this is the question I was telling you. I was expecting that they will be testing under receivables management. However, it came from cash budget. Absolutely no problem. But even without knowing financial management, still you will be able to, anything about financial management, still you will be able to handle this sum, because this is nothing but your receipts and payment account being prepared in a statement format. As simple as that. Logically, you can even do this question. So the complexity of this question is not much. It is pretty much easy only, right? Moving on to the next question, question number 1B. So question number 1B was is from the chapter leverages. Once again, in this question, it is kind of a missing figure question. They have given the entire balance sheet, right? And then they have given what your fixed cost, fixed operating cost, your VC ratio is there, which means VC ratio is 70%, PV ratio is going to be what, 30%, right? Total asset turnover ratio is there. So the starting point, you will get it. So now you have the total asset in this question. It is just 80 lakhs. Total asset into your asset turnover ratio. So into 2.5, you get the total sales figure, right? Sales minus variable cost ratio is given. You get your contribution minus fixed cost gives you EBIT minus all your fixed financial cost. You can arrive at it using your balance sheet component. With this, the entire statement can be prepared. And from there, it is this direct application of formulas, right? EPS is going to be EFP divided by your number of equity shares, operating leverage, financial leverage, combined leverage. It is all direct formula application, and the figures you will arrive here. Very simple question. Once again, guys, it's a 5-mark question here. The next one, question number C, 1C, right? This question came from Walter's model from the chapter dividend decisions, right? As predicted, I told you dividend decisions, touch Walter model or approach. These two area you do. Look, one full 5-mark question, that too in the compulsory question itself this came in, right? Once again, guys, pretty much simple and straightforward. All the ingredients were given in the question itself, direct formula application, and you can do it, right? And of course, the part B of the question, you should know what Mr. Walter says in his model. Based on that, you need to arrive at this particular solution. Once again, guys, a direct question only. Now, question number 2A. This question came in from the chapter cost of capital, right? As expected, I was expecting this chapter to come somewhere around 8 to 9 marks, but yes, it came in for 7 marks, more or less the same, right? So in this question, they've asked, yes, this question had one adjustment, that is relating to convertible debentures, right? Study material question. In fact, in our classroom discussion, we did one question which was much complicated than this, where the growth rate of your equity share was not given. We had to calculate. if you guys remember, this question had an adjustment. 5 years ago, the company paid a dividend of so much. Last year, it paid a dividend of so much. In a span of 5 years, your dividend has grown by so much. So accordingly, you need to rework and arrive at the growth rate. In this question, all those things are not required because the growth rate was directly given, and the entire challenge about this particular question was to arrive at the redemption value of debenture. Redemption value of debenture is going to be equal. For you to arrive at the redemption value of the debentures, you need to know what is going to be the equity shares value at the end of the 6th year, right? So yes, it's going to be converted in 6 years time. So this is how you need to do it, and for that purpose, the growth rate is directly given in the question. We have done a much more complicated question in our classroom discussion, right? If you are able to do that question, this question is much easier. Are you clear with this? As simple as that, guys. I don't see anything great here. In fact, one more thing. Here, if you see, there is something called as term loan, right? I taught you in our class that this is called as KT. In fact, in the study material itself, it is not there. However, it is logical only because it is a debt instrument. But I told you KT, how would you arrive at it? Direct interest into 1 minus tax rate is going to be your KT. I told you guys, right? So if you, I have in fact broken it down separately and I mentioned it, direct formula application, you will be arriving at the KT figure for the purpose of computing your WACC, right? So this adjustment was also covered specifically. In fact, a much complicated adjustment we covered in our classroom. So I think this question was much easier, right? They've asked you to arrive at KE using CAPM. Cost of convertible debentures using approximation method. Obviously, you need to use the formula. The formula also no need to mug up entire logic. I told you guys the same thing. You just need to put it here. But for the purpose of arriving at the redemption value, you need to arrive at the value of equity shares at the end of 6th year. That's about it. Cost of bank term loan. This is something called as KT that I taught you guys. And of course, here they have asked for WACC using the market value weights. Once again, guys, a straightforward question, a direct lift. Right, that's about it. Then the next question is yes, from working capital cycle. Right, this question came in from working capital cycle. Once again, guys, direct question they have asked. The direct question is what they have mentioned here. So they have given the number of days for each of the components of your working capital, and with that you need to directly do it. They have asked for working capital cycle period, number of cycles, right? That is 365 days divided by, or 360 days divided by the divided by your operating cycle period. You get the number of cycles in a year and the amount of working capital required. This is basically your working capital cycle direct application. You can do this question. Then question number 3A. This question was with respect to investment decisions. And once again, guys, this was a straightforward question only. I didn't see any kind of complications here. They have asked you to calculate NPV and profitability index, and they have asked you to advise whether this company need to go for it or not if it's a positive NPV. So even I haven't solved this question, but yes, it's a straightforward question. So what you need to do is, if it's a positive NPV, tell them that you can go for it, right? If it's a negative NPV, ask the company not to go for it. Once again, it wasn't a difficult calculation. Everything was given in the question. In fact, they have given one more thing here. Yes, working capital. They are given the working capital investments. The working capital, additionally, investment in debtor and stock will increase in year 1 by 1,50,000 and 2 lakh rupees respectively. They have given in the question here. So obviously, accordingly, you can just do this. This is also something that you need to remember. And they have also given in the question that creditors will also increase by 1 lakh. So in year 1, what happens? Current asset increases by 1,50,000. Current liability increases by 1 lakh, which means the net of 50,000 needs to be an outflow at the end of year 1. But don't worry, this amount you will get it back at the end of the tenure of the project. So you should treat it as an outflow. You should treat it as an outflow initially right now in year 1, and at the end of the life of the project, it should be treated as an inflow. This alone needs to be done. In fact, this was once again a direct question from our institute study material, which we solved in detail in our regular batch as well, right? Once again, guys, a straightforward question only. I think this is also an easy one. Then finally, coming to this question, number, what is this? 3B, right? So this question is once again from ratio analysis chapter. And this is also missing figures. Using the data, they have asked you to calculate balance. They have asked you to prepare the balance sheet. So in this attempt, if you see, ratio analysis alone came for 8 marks. It came for 8 marks. So here it came for 4 marks and 4 more marks in your MCQ component. So this attempt, they are given more importance to ratio analysis. And guys, I told you specifically balance sheet preparation, missing figures, that area is only they have tested something that is the area which they have tested here, guys, right? And that's about this entire paper. Of course, the question number 4 is fully theory, right? So that's about this paper. Overall, in my opinion, the paper was easy. Here and there, a few questions could have been lengthy, right? Maybe that's something that that depends more about on your practice. Maybe if you practice really well, if you're really good with using the calculator, absolutely you might not have found it lengthy, but in general, one or two questions here, especially that capital structure question, I found it to be a little lengthy, guys. And of course 45 marks came exactly from the one day before exam strategy. That's the reason why I tell you time and again, guys, it is all strategized, right? You just focus on this. Obviously you would have seen how beautifully it came here. The same thing happened for costing as well, right? So that's about this entire paper review and MCQ solutions of your paper 6A financial management, your CA inter Jan 25 attempt, right? So you guys have done your part. You guys have given your level best. You have worked hard, and right now it's time for you to party harder, right? All the very best. I will meet you all in CA final.